Welcome back to the deep dive. Today we're looking at a single piece of infrastructure that is fundamentally redrawing the economic map of an entire nation.
We're talking about the Kathmandu-Terai Expressway in Nepal. Most people just call it the fast track.
And this really isn't just a story about a new road.
Not at all.
Yeah.
The sources we've synthesized, they paint this picture of really a massive economic upheaval. Our mission today is to get into the mechanics of what we're calling a value reevaluation engine.
A value reevaluation engine, I like that.
Because this fast track is breaking what has been the iron law of Nepali commerce for generations.
And that law was?
Simple. Proximity to Kathmandu is everything. That was the single biggest factor for commercial success, for real estate value, for everything.
So we're talking about a tectonic shift. A geographical premium that's existed for decades is, well, our sources say it's rapidly becoming obsolete.
It is. The whole logistical center of gravity is shifting south.
And that's creating this golden mile of opportunity we'll get into. But also, and this is crucial, it's starting the clock on a stranded asset time bomb right in the capital region.
A binary outcome, really.
Mm-hmm.
And the consequences for investors, for business leaders across Nepal,
Yeah.
they're immediate.
Okay, let's unpack that. Let's start with that original iron law. For decades, if you were setting up any kind of large-scale operation, logistics basically dictated every decision you made.
It was pure geographical determinism.
Mm-hmm.
I mean, a warehouse in Thangkot, right on the edge of Kathmandu,
Mm-hmm.
it held vastly more value, both monetary and strategic, than a much bigger, maybe better plot of land down in the Terai near Bara,
Just because it was closer.
just because it shaved off hours of, frankly, agonizing transport time.
So let's quantify that. What was the inefficiency that the fast track is designed to just eliminate?
Right. We have to get specific here. Nepal's commercial lifeblood, it flows through the Burgundy-Rexall border with India.
That's where most of the goods come in.
Over 60% of the entire nation's trade. And the journey from that border to Kathmandu, it's only about 135 kilometers. But on the old roads, the Prithvi and Tribhuvan highways, it's a logistical nightmare.
The time it takes is the real killer, isn't it?
A killer is an understatement. Depending on traffic, weather, road conditions, that 135-kilometer gauntlet takes 8 to 12 hours.
8 to 12.
Think about that variability. A trucker might leave in the morning and get there by evening, or he could be stuck for half a day. For the listener, what that means is that uncertainty puts a huge time cost penalty on every single thing consumed in Kathmandu.
So what's the business consequence of that high, unpredictable time cost?
It forces you into a really expensive, really suboptimal model, the just-in-case inventory system.
Because you just can't trust the supply chain.
You can't, so you have to buffer against delays. That means stockpiling goods in these cramped, very expensive, frankly poorly sited industrial lots on the valley's fringes.
Places like Balaju, Bhaktapur.
Exactly. They became these expensive holding pens. You were paying an incredible premium for proximity just to have a supply buffer.
So any chance of using modern just-in-time logistics was basically zero. The high real estate cost was just an unavoidable inventory tax.
Precisely. You sacrificed efficiency, you sacrificed square footage, because the cost of having your truck stuck on a highway for who knows how long was even higher.
And this is where the fast track comes in. You called it the economic recalibration machine. How does it just demolish that old logic?
The change is instantaneous. It's structural.
Mm-hmm.
The new road cuts that travel time from the Burgundy corridor down to, reliably, under 2 hours.
Under 2 hours.
So predictability replaces that punishing variability. And what that means is the strategic imperative for warehousing completely flips.
Okay.
You're no longer trying to be close to the consumer in the city. You're trying to be close to the source of goods, the Burgundy customs point, and the new super efficient transport nexus, which is the fast track itself.
So the idea is get the goods through customs, get them into a huge centralized warehouse right there, and then use the fast track as a fast, predictable shuttle into the city only when you need it.
That's the new model.
Yeah.
And it's all driven by the cold, hard math of operational cost.
Right.
A big company can now build a huge, state-of-the-art warehouse on cheaper, much more plentiful land in that Pathway and Nijgadh corridor.
So you're trading a cramped old warehouse for...
Imagine it, the old way.
Yeah.
10 hours of slow trucking to a tiny warehouse in Thangkot, the new way. 30 minutes from customs to a modern automated hub in Bara, followed by a 90-minute high-speed, just-in-time shuttle into Kathmandu.
And the cost savings on the land alone. I mean, moving from Kathmandu fringe prices to Terai prices, that must be enormous.
It's textbook economic arbitrage. The inefficiency of the old road was basically subsidizing that old, expensive real estate in the valley. The efficiency of the new road just pulls that subsidy away.
Which perfectly explains the frenzy we're seeing around Nijgadh. The headlines are all about this astronomical surge in land prices. What used to be, fallow farmland is now selling for rates that rival parts of Kathmandu.
And this is where you have to be careful. It's easy to just call it a real estate bubble.
But it's not that simple.
No. The sources suggest it's better to think of this as a nascent, maybe a little chaotic, but a futures market. People aren't just buying dirt. They're buying a stake in the future of Nepali logistics. The value is coming from what economists call agglomeration economies.
Okay, break that down for us. What does agglomeration mean for someone not tracking supply chain theory?
Well, think about why tech companies cluster in Silicon Valley or banks in a financial district.
They feed off each other.
Exactly. Every new business that moves in makes the location more valuable for the next one. In Nijgadh, a new factory needs a warehouse. That warehouse needs an equipment depot. That depot needs mechanics and fuel stations. It's a cycle.
And that power is multiplied by this logistics triangle that's forming.
It's a self-reinforcing trifecta, really.
Right.
First, you have the fast-track southern end. Second, the proposed Second International Airport, the SIA. And third, the existing Samara Special Economic Zone, the SEZ.
So you have road, air, and an existing manufacturing base all in one place.
Right. Pathlaya is the established industrial base, Samara is the manufacturing core, and Nijgadh sits right at the junction, ready to become the big distribution hub for all of it.
Makes sense. Now, the sources say there are two different kinds of buyers driving this.
And that distinction is key. First, you have the passive land bankers. They're just trying to flip plots, and they're the ones creating a lot of the volatility.
They're riding the hype.
They are. But the more important group, the one driving the long-term value, those are the sophisticated players.
The big industrial houses, FMCG giants.
Absolutely. They're making strategic land acquisitions to build a competitive moat. They aren't looking to flip a small plot in 2 years. They are securing a critical node, a primary distribution center that they know their competitors won't be able to replicate for a decade. They're buying future efficiency, not just real estate.
This all sounds like a massive upside. But this is where the warning bells start to ring in our sources. The hard infrastructure, the road, is useless without the soft infrastructure to support it. What's the big risk?
The risk is a failure to plan. I mean, look at successful logistics corridors anywhere in the world. Manesar in India, for example. They didn't just happen. They were guided by really robust land use plans, by zoning frameworks that allowed for massive consolidated logistics parks.
And Nepal doesn't really have that right now, correct?
It doesn't. So the critical danger is that this golden mile becomes a fragmented mess of tiny, haphazardly built plots. If you can't get a big piece of land together for a modern depot, you kill the efficiency gains.
Can't get the scale you need.
Exactly. Large container trucks need wide turning circles, easy access, shared utilities. Fragmentation makes that impossible.
So the government's most important job right now isn't the road's construction budget. It's imposing a clear master plan for land use around these interchanges.
It's an urgent imperative. That master plan is what will decide if this hugely expensive road actually delivers its promised economic transformation, or if it just becomes a fast road surrounded by a messy, underutilized, speculative area.
Which brings us to the other side of this coin, the inevitable crisis in the capital. The sources call this the stranded asset trap. That sounds pretty dramatic.
It's an unanticipated premature devaluation. First, let's just define stranded asset. Think of a coal-fired power plant. 20 years ago, a great asset. Today, with the shift to renewables, it's basically obsolete.
Devalued not because it's broken, but because the world changed around it.
Precisely. And in Nepal, the victims of this are the old industrial properties, the go-downs, in places like Thankat, Balaju, Nepal. Their primary asset, their location, is just evaporating.
The high-volume logistics that justified their crazy valuations are just moving south.
And this process is gradual, but it's inexorable. That's why we call it a time bomb, not an explosion. It happens in 2 predictable steps.
Okay, walk us through that.
Step 1. Rental yields start to decline. As the fast track gets closer to completion, the big national companies, the anchor tenants, they start planning their move to the cheaper, more efficient Bara-Parsa corridor. The supply of warehouse space in Kathmandu stays the same, but the demand for those big spaces just plummets, rents fall.
And step 2 follows from that.
As the tenant pool shrinks, property values stagnate, and then they fall. The number of buyers for a multi-million-dollar warehouse in Sangkut that offers zero logistical advantage, it just disappears.
This has happened before, hasn't it? There are global parallels.
Absolutely. The sources point to London and the M25 orbital motorway. When that opened, land values soared at the new junctions on the periphery. But the older industrial parks inside the ring, they struggled. They had to be repurposed or they faced decay.
So these older properties in the valley, they won't be worthless overnight, but they can't function as they used to. What's the adaptation path for them?
It's a downward filtering process. They have to transition from being these large national hubs to smaller, more specialized assets. The most viable path is probably repurposing them into last-mile fulfillment centers for the e-commerce market inside the valley.
For companies like Amazon or local delivery services.
Exactly. Or, if the location is good, maybe they get converted entirely to residential or commercial use. But that takes a lot of capital.
Which leads to the urgent question for any investor holding these properties right now. What do they do?
The analysis is pretty brutal. You have a choice. You either divest now, aggressively, before the market fully prices in this obsolescence, or you develop a credible, well-funded plan to repurpose that asset. Sitting still and hoping for the best is not a strategy.
And that really is the hard truth here. This southward shift of Nepal's logistical center of gravity is irreversible. The economic logic is just too compelling. Any strategy based on that old Kathmandu-centric map is, well, it's steering right towards a competitive disadvantage.
Which leads us to two possible futures, two scenarios that depend entirely on the planning decisions made right now.
Let's contrast them. First, the best case, the optimal scenario.
That's the planned corridor. It relies on the government implementing that comprehensive zoning, the master plan we talked about. If they do that, they'll attract FDI, global logistics players, and you get an efficient world-class hub that lowers costs for the whole economy.
And the other path, the more chaotic one.
That's the speculators' free-for-all, is what happens if the government fails to implement zoning. The land stays fragmented, large logistics parks can't be built, and the full efficiency gains of the fast track. They're never realized. You just get a messy, underutilized industrial suburb.
So this road, it's more than just a road. It's an instrument of economic reorganization. It's going to sort the winners from the losers for the next generation.
It is. So for you, the listener, the questions are immediate. If you're a manufacturing CEO, you have to be asking, what's my 5-year plan to move my primary warehousing to the Terai? And if you're an investor with land in Sangkut, the question is even simpler. What's my exit strategy?
A story where infrastructure doesn't just enable growth, it really does determine destiny. You've laid out the mechanics of this value shift perfectly.
And here's a final thought to leave you with. Everyone's focused on the skyrocketing price per plot in Nijgadh. But the ultimate winners in this logistics futures market, they won't be the passive speculators just flipping land.
So who are the real winners?
They'll be the operators, the ones who can convert that high-priced land into sophisticated cash flow-generating infrastructure. Things like temperature-controlled cold storage, state-of-the-art container depots, high-security customs zones.
So the land boom is just phase one.
It is. The success of this whole speculative frenzy depends on swift, large-scale commercial development and a lot of specialized capital. That's a factor people often miss when they only see the rising price per acre. The road is almost done, but the real work of building a modern supply chain is just beginning.